Hello again. This is another video for building blocks for putting deals together. And these are terms that I think are really important, and if you put all these terms together, these financial terms, they really give you a better understanding and confidence about how to analyze deals, make offers, put profitable real estate deals together. And this video I'm going to talk about positive leverage and how positive leverage actually equals bliss. And that's a pretty big term to describe something in a financial term, but I really and this is such an important concept that I wish I had learned in the very beginning, and I really had to learn it by getting burned a little bit, having some deals that had negative leverage and they were not blissful. And so I want to introduce this as one of the building blocks, because I think if anybody borrows money and takes or borrows money or gets seller financing or uses lease options, you should understand this concept, because it's so important to making sure you put together safe and profitable deals when you use leverage. So I say, kind of my little phrase here is, don't leverage without it. If you don't have positive leverage, you don't leverage without it. And so I'll explain what this is a little bit so you can understand it better. And so just in general, what it means to have positive leverage is the cap rate of your deal. And we've talked a lot about cap rates. If you don't know what that means, go back and watch some of my other video on cap rates. So cap rate compared to the financing cost. And we also did a video on financing costs, but I'm just going to review here. Remember, financing cost is the total cash flow that is expended for your financing. So that includes principal and interest, or if it's an interest-only loan, interest only. But whatever your costs are for financing, whatever goes out the door to your lender is your financing cost. And so what I'm saying is, whatever your cap rate is compared to your financing cost, if your cap rate or your net operating income is more than your financing cost, you've got positive leverage. If your cap rate, and that is associated with your net operating income, so the total income this property is producing, is less than your financing costs, then you have negative leverage. I know this sounds really basic when I'm explaining it here, but you'll be amazed, both if you look at some of your own deals, if you're already doing real estate, or if you look at a lot of the deals that other people think are so-called good deals, borrowing money, how many times they have negative leverage. And so this is something you need to drive home, put in your brain, that I will do deals with positive leverage. It'll make your life much easier. So I'm going to show you two scenarios that will explain what I mean by this and hopefully make it a little bit simpler. So scenario one is we're going to buy the same house we've been playing around with from the very beginning in my videos. It's a house for $100,000. The net operating income on this house is $7,200. It's a little fuzzy there, I hope that picks up. And the cap rate is 7.2%. So just a simple single family house. And in scenario one, in both scenarios, we're going to put $20,000 down and we're going to borrow $80,000. So scenario two, same way. Pay $100,000 for this property, put $20,000 down, $80,000 financing. And just assume that maybe both of these are seller financing. The seller agreed to do that. And so you're negotiating with them. But in scenario one, here's where the difference is. This is a 4.5% interest rate in scenario one. It's also a 4.5% interest rate in scenario two. But it's a 30-year financing, so it's a longer period of payoff in scenario one, so 360 months, versus scenario two is 15 years. And what that means is, to pay it off in 15 years, you're going to have to have a higher payment, a higher monthly payment. So to do that in this scenario two, your payment's $612. In scenario one, your payment's $405. So $405 versus $612, and on a yearly basis, a $7,300 in financing costs. So the total amount of money we're spending on financing on a yearly basis is $7,344, and on the 15-year note or loan, and it's $4,860 on the 30-year. All right, so that's the financing cost. Remember, that term's important when we're comparing it to cap rates. And let's get that to a percentage basis. So $4,860, our financing cost, divided by our total amount of financing, $80,000, equals 6.08%. So we've now gotten it to a term we can compare with cap rate. So 6.08% is our financing cost in scenario one, our percentage financing cost. Now let's compare that to the cap rate. What was the cap rate? 7.2%. So which one's more? So we have our cap rate 7.2% versus our financing cost of 6.08%. So we have a positive leverage in this case. Positive leverage. Let me show you, this will show you the second scenario, and I'll explain why this is important after I put both of these together. So remember scenario 2, $612 per month is our financing cost, $7,344 per year. And on a percentage basis, $7,344 divided by $80,000 is 9.18%. So our cap rate of 7.2% versus our financing cost 9.18% this is a negative leverage scenario. So what that means, let's write down the net operating income as well. So we have $7,200 coming in from this property, and going out is $7,344. All right. So we have invested $20,000 in this property, and what this means economically is that the property produces $7,200. It gives us $7,200 to pay our bills, and yet our bills at the end of the day are $7,344. So by about $144, we have negative cash flow. So we are getting a less than 0% return, cash on cash return. So if you remember our cash on cash video, where you take the free cash flow, the cash flow after financing. In this case, is negative 144. So cash flow after financing divided by our total investment. So our total investment of $20,000. So 144 divided by 20,000. That's a negative number. I'm not even going to figure it out, but it's just a little bit below 0. That's not good. In the investment world, we don't have to be experts to know having a negative return on investment, cash on cash return, is not good. And so that I have done deals and didn't realize it till after the fact that it was that kind of a return, and that the cost of that when you put your $20,000 into a deal and have it sitting there for maybe years, and I might have a lot of principal pay down. That's fine. I'm paying this loan down over a 15-year period, and that's nice on paper. But when you're running a business, if you're not getting cash flow coming in, I'm a conservative investor in that I just focus more on cash flow than the profitability over the long run, because that's what you can eat. That's what you put on the table. That's how you pay your bills. And so if you're going to be using leverage, you've really got to make sure you don't do deals that have negative cash flow, because you're tying up money that has an opportunity cost. You could go invest that money in another deal that has a 6% return. Or you could have invested it with different kind of financing. In scenario 1, where you had positive leverage, where $7,200 was the net operating income, and your cost of financing was $4,860. And so what's the difference between those two? Let's show you how much positive cash flow we have in this case. What we could have had if we made a different offer to the seller. So $7,200 minus $4,860 is $2,340. So that's our positive cash flow. We have positive leverage, therefore we have positive cash flow. And so let's figure out what our cash on cash return is. I think we did this in the last video, the same numbers. So 2,340 divided by 20,000. 2,340 divided by 20,000 equals 11.7%. So the same number we had before. So this is where the cash on cash is very helpful. If you can compare 11.7% by having the exact same purchase price, the exact same amount down, the exact same interest rate, but just a 30-year versus a 15-year note. And we have 11.7% cash on cash return, and we have a negative return. That's 144 negative divided by 20,000. So just so you can have some numbers here, we're about a negative 1% approximately. So a negative 1% return, 11.7% return. And this is all in terms of cash flow. One of these days, I mean, if you can get by with this negative cash flow, and there are some cases where 1 or 2 deals, maybe you have highly amortizing deals that don't produce a lot of cash flow, but then you pay it off in 10 years, and your plan is to get this thing free and clear really fast. If you make that choice, that's fine, but at least you do that going in knowing I have a negative 1% cash on cash return. I am okay with that going in. And if you know that, if you have the funds to handle that, if you're looking at it as an investment and you don't need the free cash flow right now, that's great. But a lot of people get into deals thinking they're going to be making money on a rental property, or thinking that's a wise thing to do, when they don't have enough money, cash, to handle that. And so knowing about positive leverage, building deals, especially early on in your career that do have positive leverage, will lead to investment bliss. You'll be much happier, take my word for it. You don't want to have to go the other way and have some unblissful deals that you have to deal with. And so just remember, you want your cap rate to be greater than your financing cost, another way to look at that, your net operating income will be greater than your financing cost so that you have positive cash flow. All right, we'll see you in other videos. I've enjoyed sharing some of these building blocks, and we will build upon this and do some formulas and teach you a lot more coming up in some other videos. See you soon.